Well, welcome to our High Rock clients and any other listeners who have joined us this week. And thanks for taking the time to tune in to our weekly webinar where we will talk about what we see happening in the global economy, financial markets, and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategy. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock. Our financial planner, Bianca Tomlinson, is also on the call, and we will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. Well, today we are celebrating International Women's Day at High Rock. Now, the World Economic Forum predicted in 2014 that it would take until 2095 to achieve global gender parity. 1 year later, in 2015, they estimated that a slowdown in progress meant that the gender gap wouldn't close until 2133. So let's take a moment to talk about gender equality. The most important determinant of a country's competitiveness is its human talent through the skills and productivity of its workforce. So organizations need to illuminate the path to leadership, showing women the career advancement opportunities that match their skills and professional objectives and provide the experiences necessary to fulfill their potential. Now, individuals can commit to advocating for themselves and, when appropriate, becoming effective role models and sponsors of women to help them achieve their goals. Studies show that gender-balanced organizations and teams deliver stronger results and that inclusive societies are more progressive, but ingrained bias slows the progress of equality. Organizations must build cultures where all people feel valued and included and can contribute fully according to their capabilities. Individuals can commit to learning about their own biases, adjusting their behavior as needed, and welcoming different experiences and points of view. Companies with women board members outperform in return on equity, net income growth, and price to book value, as well as a host of non-financial measures. Organizations must ensure women are exposed to strategic operations and functions to gain the experience needed for senior positions and set measurable targets for appointing women to leadership. Individuals can show potential or current employers that they value and expect gender-balanced leadership. They should seek out leadership, sponsorship, and mentoring programs, exposure to strategic and financial roles, and integrated networks designed to help women advance. Raising the female labor force participation rate to match that of men will have a positive impact on GDP in both developed and developing economies. Organizations must ensure all their talent processes are equitable, fair, and that they further their gender parity and diversity objectives. Individuals can seek out perspectives different from their own, prioritize building diverse teams, and engage in mixed networks that build trusted relationships. And after competitive pay and benefits, workers in 8 countries rank working flexibility and still being on track for promotion as what they value most in a potential job. Organizations should recognize that lines between career and personal lives are becoming more fluid. They should create progressive policies like flexible working that allow everyone, regardless of age, gender, rank, or geography, to manage their personal and professional lives and realize their ambitions. Individuals can create trusting, team-oriented work environments by encouraging flexible working, supporting choice about the times, places, and ways work gets done. At High Rock, we think it is important to recognize all of this and stress the need for further advancement in the goal to narrow the gap in a more timely manner. Let's quickly review our themes for 2016 before we get started on what happened last week. Our overriding theme for 2016 is that financial markets will remain volatile. Now, January saw a spike in volatility, but markets settled a bit in late February, but uncertainty has certainly not gone away. Financial markets are just learning to deal with it. The big question is whether the U.S. economy will continue to be able to grow while less positive global economic forces are providing a drag. The consumer is providing a lift to the domestic economy in the United States, but is this sustainable? Commodity prices, and especially oil, have stopped declining for the moment. Core inflation in North America has picked up, but not so in other parts of the global economy. Central banks all meet and will announce any adjustments to their monetary policies over the course of the next couple of weeks. Now, will this temper uncertainty, or will it add to it? Geopolitical wildcards like the UK leaving the European Union, the Donald Trump factor, OPEC and oil-producing nations, China, North Korea, terrorist activity, and the refugee crisis are all increasing uncertainty. As they always do, bond markets may hold the clues, but with some central banks forcing negative interest rates, is the picture being distorted? Are other credit markets telling us a different story? Equity markets remain expensive, although somewhat less so than last May. Earnings growth has declined over the last 3 quarters, and 2016 estimates continue to get revised lower. And we remain in a time of lower than average returns when, after 6 years of above average returns, and as all things do over time, returns are moving back toward the average. Well, plenty has happened since our last webinar, so let's get right to the financial markets and see what's been going on. In keeping with our key theme for 2016, it has been a wild ride since the beginning of the year. Now, volatility declined last week until Friday, but added uncertainty over the latest economic readings from the U.S. and China, as well as some concerns over the European Central Bank's next moves, have brought volatility back closer to its longer-term averages. CNN Money's Fear and Greed Index hit a low near 9 in January. Now it has moved back into greed territory. Markets have moved rather quickly from being oversold a few weeks ago to overbought currently. Now, we suspect that the next move is likely going to take us lower. Well, since our last webinar, our benchmark World Equity Index has grown by approximately 1% and is now lower by only 3% on the year. Last week, it was lower by about 4.5% on the year. The TSX was the best performer since last Tuesday. The UK's FTSE 100 was the worst performer. Now, in December on BNN's The Close, I suggested that it might be a reasonable strategy for 2016 to be overweight the underperforming Canadian equity market and underweight the outperforming U.S. equity market for rebalancing purposes. At this time, that strategy appears to be working by about 5.5%. The TSX has been the best performing country index in the developed world this year so far. Well, after hitting highs last May near 63, our benchmark World Equity Index made new lows near 49 in mid-January and then again in early February. That was about a 22% drop from the highs before it found support from short covering and a little value investing after such a large decline. The downtrend, however, still remains intact as we are now experiencing lower lows and lower highs. Now, we could see some buying potentially drive prices to the new downtrend line at or near 56 to test some sellers. A break of that line would change the medium-term outlook to positive. However, until this pattern and downtrend is broken, we should be on guard for further selling pressure. We have been and will use better values to nibble away at this opportunity, although we are still sticking to our overweight cash thesis until we see more positive markets developing. The S&P 500 held support just above 1,800 a few weeks ago, close to the long-term uptrend line, which would need to hold to keep the long-term positive trend intact. Certainly, we still do not see value at current levels, and as I'll discuss in more detail later in the call, the fundamentals are not enough to inspire us. In the near term, there may be some relief buying. We've already seen some of that. Some might call this a bear market rally that could see prices move back to the downtrend line at or about 2060. Last week, they got to 2,000 before retreating a little bit this week. But those with less confidence will likely use that as an opportunity to reduce their exposure to overpriced assets. Longer-term momentum for the moment still favors the sellers. Additionally, volume on the up days remains well below average, while volume on the down days remains heavy. That is definitely not a positive sign. Well, Canadian U.S. bonds are modestly stronger since last Tuesday, and the Canadian Preferred Shared Index was the best performer over the course of that time. The Canada-U.S. 10-year interest rate spreads widened to 63 basis points from 56 basis points last week, which had been the narrowest since a wide of near 90 basis points in mid-January. Now, stronger U.S. employment data was likely the catalyst for that. Tomorrow, the Bank of Canada will announce its latest monetary policy decision, and Friday of this week, we'll get the most recent data on the Canadian labor force survey. Well, oil has been the big story, and again this week, as the downtrend from June of 2014 appeared to get broken. Oil is up by over 30% now from its lows. 2 weeks ago, we suggested that the long-term downtrend line may be tested in the not-too-distant future, and that is what happened, although we think there will be considerable resistance at or about the $38 to $40 level as additional supply may come on stream at higher prices. Meanwhile, trade data from China is indicating that demand is not likely to pick up soon in that economy. Well, commodity prices have moved higher over the last few weeks. Longer term, commodity prices are off of their lows and appear to have stabilized, at least certainly for the time being. The Canadian dollar continued to move higher over the last week, with higher oil prices reaching about 75 cents US before slipping back a bit. We have used this opportunity to add to some of our US dollar holdings. 6 weeks ago, the Canadian dollar hit levels not seen since March of 2003, near 146 or 68.5 cents US. Now, since it has strengthened to test and break the short-term trend line at or about that 136 level or 73.5 cents US before moving, as I said earlier, to the 75 cent US level. Now, we think that this move may be running its course, certainly at least for the short term. Longer term, there may be the possibility of testing that 77 to 79 cent level, but we don't expect to see that for some time in the future. Our benchmark World Equity Index is comprised of about 52% of U.S. companies, so we keep a very close eye on what is happening in the U.S. economy. The U.S. Federal Reserve raised interest rates in mid-December and held them steady through January, citing that they saw improving labor market conditions and increasing household and business spending, but were concerned with exports and global economic and financial developments, which is code for higher levels of volatility around the world. As you all know, this is our key theme for 2016. The next meeting is March 15th and 16th. We expect that the Fed will hold rates steady at that time. Well, back in December, the Fed had a particularly optimistic outlook. U.S. Federal Open Market Committee members suggested an average of 4 interest rate increases in 2016. Well, the probabilities now suggest that this could be significantly modified at the next Fed meeting. Core inflation in the United States has started to move higher, approaching the Fed's 2% target. And last Friday's employment situation report for February revealed further growth in employment, but an erosion in earnings. Generally speaking, the U.S. economy is adding jobs, but they are lower paying jobs, not exactly inflationary economic activity at this particular point in time. Meanwhile, jobless claims jumped last week, but the most recent trend appears to me moving sideways in this indicator. This is a forward-looking indicator, and we'll keep a close eye on this as we go forward. Rising inflation, continued employment growth, rising incomes, and a strong consumer are driving the domestic economy in the United States. But high wholesale inventory to sales ratios have preceded all of the past 3 recessions, and currently they are quite high still. So we're carefully monitoring this indicator. Now, high inventories have warranted a slowdown in manufacturing. Manufacturing index picked up slightly in February, but remains in contraction below that 50 level. Well, the GDP forecast for the first quarter of 2016 rebounded through mid-February as economic data attributed to the consumer improved. Inventory buildup and continued contraction in manufacturing data actually, though, pushed the outlook back below 2%. But adding in the most recent employment data, it is now sitting at just a little bit above that 2% level. The U.S. economy appears to be withstanding global economic pressures at the moment. The big question mark is, can this growth be sustained in the current global deflationary environment as China and emerging economies continue to struggle? There are lots of schools of thought on both sides of this question. We would argue that there is still plenty of potential downside for the global economy, but the wild card is still how the U.S. economy and the consumer specifically will be impacted in the medium term. With employment growth continuing in the U.S., the consumer could be an important catalyst. Remember that the U.S. consumer is approximately 70% of the U.S. economy. And we're closely monitoring this scenario for its implications on financial markets and investment strategy. It is expected that the U.S. economy will contribute to over 20% of the global economic growth this year. That is one of our themes for 2016, but the big question is, will it be enough? So let's have a look at what's going on in the rest of the global economy. Euro area companies represent about 16% of the world index. The European Central Bank policymakers considered it necessary to review and possibly reconsider their monetary policy stance at its next meeting. While incoming information had confirmed the ongoing moderate recovery and had provided solid evidence that the monetary policy measures were working as intended, downside risks had increased again amid heightened uncertainty about the growth prospects of emerging market economies, volatility in the financial and commodity markets, and geopolitical risks. The next European Central Bank interest rate decision comes on Thursday of this week. Well, Japanese companies represent 8% of the world equity index. On January 28th, the Bank of Japan shocked the global markets by introducing negative interest rates. And agreed to charge financial institutions an interest rate of negative 0.1% for excess reserves parked at the bank. And this is to obviously encourage banks to increase their lending. It still remains to be seen how that will, effective that will be. Companies in the UK represent 7% of the global equity index. The Bank of England Monetary Policy Committee voted unanimously to maintain the bank rate at 0.5% on February the 4th. Policymakers expect inflation to remain below 1% this year. GDP growth forecasts were lowered to 2.2% for 2016 from an earlier 2.5% estimate. Growth for 2017 was also downgraded to 2.4% from 2.7%. Now, the Bank of England will announce its next interest rate decision on March the 17th. Well, Britons will vote on June 23rd whether or not to remain in the European Union. There are potentially significant economic implications for the UK as their participation in the European Union will be decided at that point. At the moment, the polls are showing that those who wish to remain in the Union hold a slim advantage. The pound has been under continued pressure but has bounced off of recent lows. The Chinese companies represent 2.5% of the world equity index. China reported its largest monthly drop in exports since the financial crisis. The Customs Administration said exports in February fell 25.4% in dollar terms year over year, compared with a drop of 11.2% in January. Imports also declined, falling 13.8% last month, the agency reported, compared with an 18.8% drop in January, in a further cooling of demand in China that is affecting its Asian neighbors as well. At Saturday's opening of the National Legislature's annual session, which runs through mid-March, Premier Li Keqiang pledged to ensure the economy grows at a rate of 6.5% this year, saying the government will use infrastructure spending, tax cuts, monetary policy, and a higher budget deficit. On February 29th, in an aggressively stimulative move, the People's Bank of China lowered the amount of deposits banks must hold in reserve by half of a percentage point. In Canada, where companies represent 3% of the world index, on February 24th, the Bank of Canada issued a report entitled Connecting the Dots, Elevated Household Debt and the Risk to Financial Stability. We talked about this last week, but I thought I'd bring it up again. This is intended to highlight the increase in household debt and how it has been driven by the increasing debt levels of already highly indebted households. According to the Bank of Canada, simulations suggest that in response to a shock of an increase in unemployment of 5%, household arrears rates could rise significantly. Now, about 20% of this estimated rise would be attributable to the increase in debt and its greater concentration among highly indebted households that have grown since 2007. The rise in household arrears could force some vulnerable homeowners to sell their homes or eventually default on their mortgages and other consumer debt. If defaults rose quickly, or if many households were forced to sell their homes, house prices would drop sharply across Canada, particularly in Vancouver and Toronto, which have recently experienced exceptionally strong price growth. Based on this, they have put the Financial System Review risk level to the Canadian economy as elevated. The Bank of Canada will announce its latest interest rate decision tomorrow. So what do we see on the horizon? Well, bond markets tend to lead other financial markets, so let's have a look at what's going on there. In the government yield curves, generally they steepened this week as U.S. employment data were better than expected, and as the European Central Bank is now expected to further add monetary stimulus to the economy. We can look at Japanese short-term maturities that are now negative out to 17 years. In Germany, negative yields carry out to 8 years. Last week, Paul talked about the potential of increased defaults in the energy sector to impact the financial system in the longer term. Well, high-yield bonds have actually been rallying lately. Yields have fallen and the spreads to government bonds have narrowed considerably. Historically, high-yield bond markets lead equity markets, and while the current gap remains to be closed and makes equity markets still look relatively expensive, the gap has narrowed as record inflows into high yield have narrowed the spread to equities. As for equity markets, when investors buy stocks, they buy a stream of future earnings. The price to earnings ratio represents a metric to measure stock prices relative to earnings. 10-year average price to earnings ratio is currently at 14.2 times. The 12-month forward price to earnings ratio is currently at an expensive 16.1 times. Last week it was a bit cheaper at 15.7. At the equity market's highs back in May of 2015, it was 17.1. Now, as a result of downward revisions to earnings estimates, the estimated year-over-year decline for the first quarter of 2016 is a fairly significant minus 8%, which is below the expected earnings growth of just 0.3% on December 31st of 2015. Now, for all of 2016, analysts are projecting earnings increases of 2.9%. At the beginning of the year, analysts had projected 2016 earnings growth of 7.4%. So when the green dotted line, S&P 500 prices, reaches the blue line, S&P 500 earnings, we can become more comfortable with the S&P 500 companies, but not until then. As for the other value metric that we like to look at, enterprise value to earnings, when equity markets were lower last month, S&P 500 companies were valued at current market prices at near 12 times, the longer-term average near 10. Well, the recent rally in stocks has pushed enterprise value higher, back towards 13 times and well above the longer-term average. This has prompted us to take some sales to further lighten our exposure to the expensive U.S. equities. Now, when investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell. So margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May and lower again in January of this year. That trend definitely inspires caution toward equity markets. And when the spread between large cap markets like the S&P 500 widens over small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies and is considered unhealthy. That had been happening, and there had been a reasonably wide gap between the S&P 500 and the Russell 2000. Now, when markets fell, that gap narrowed considerably, but that gap has widened as large cap markets have rallied, while the broader Russell 2000 has lagged. This also makes us more cautious on this equity market bounce. So what does it all mean? Well, as I continue to say, since last May, we've taken a defensive posture to investing here at HighRock, and in light of our key theme for 2016, we still remain defensive. We have picked away at some value opportunities, but remain overweight cash for the time being. Central bankers and most economic forecasters are uncertain of the path of the global economy. So are we. And as Paul suggested in the Globe and Mail article a number of weeks ago, we are somewhat worried about the prospect of deflation and its effect on capital markets. Now, our discipline, as we often refer to it, is at all times to protect our and our clients' capital, and especially so when we see the warning signs of potential problems. It is easy to be and stay fully invested at all times, and that is why most advisors might recommend sitting tight on a fully invested strategy. In many cases, as non-discretionary advisors are required to do, it is significantly more difficult to adjust assets and positions one household at a time. That is why we use discretionary management, so that we can move all of our clients at the same time. We can be quicker, more efficient, and more impactful. Cash and cash equivalents have been and continue to be important defensive assets, so we are carrying greater than normal cash balances in our models. Now, with equity market values having fallen so rapidly to begin 2016, we were able to find some opportunities to add reasonably cheap assets. Now, this does not change our defensive strategy. We are being patient and adding small percentage weightings at a time, leaving lots of ammunition for future equity market weakness and assets with better value if and when we should get it. Now, if we don't, we can and will adjust our strategy quickly. Risk is significantly lower now than it was last May, so we are much more comfortable adding assets at levels where we see value. In January, we added a position in Paramount Energy at $3.50 to our tactical model. Yesterday, we sold it at $8.93. And I'm going to bring in Paul briefly just to give you a little bit of an idea of what he was thinking at the time.
Thanks, Scott. As I think you pointed out on a slide a few ago about the high-yield energy bonds being hammered, well, obviously the stocks were as well, and stocks, as people know, are way more volatile than the underlying bonds and obviously less secure. So some of these stocks have been hit down so hard. As an example, Paramount Energy, which is largely held by the Riggle family in Calgary, was up around $65 a year and a half ago. And they were issuing stock to the public at that price point, and this stock got down, I should have this up in front of me, but it got down as low as, $2.86 from $65 a short while ago, or even down from $6 last fall. So these things have been hammered. We ended up getting pretty lucky buying some at 350. I felt like it had very good value, in fact, better value than the bonds. We flipped out of it yesterday at $8.93, as you mentioned, Scott, which is about 2.5 times the value. Now, we didn't have a huge position in it, but like all of our positions, we are trying to remain disciplined and add value where we can without taking big losses, because the market is still very volatile. So just an example of what we're doing in the tactical portion of your and our portfolios.
Well, thanks, Paul, and that was great work. And I just want to stress to everybody how your research and how the in-depth research that you do adds significant value to some of the work that we do here at HighRock. And so, well done. Well, our HighRock models are built to incorporate the need for diversity and balance with fixed income, global equity, and that tactical mid and small cap company model. As Paul was just mentioning, that's where we do some of the more tactical trading as he was doing. Now, as volatility increases, the cash in client accounts and the underweight nature of our exposure to equity markets and the negative correlations between equity markets and bond markets helps us to mitigate the impact of volatility on our portfolios. So far this year, our global benchmark equity index is down about 3%, as I mentioned earlier. Now, a typical 60% equity portfolio and 40% fixed income portfolio built with our models is now close to flat on the year. And of course, that depends on the structure of an individual portfolio. This is a significant mitigation of risk and volatility in part as part of our ongoing active management. Well, as I mentioned last week and again this week, we will be sending out an email to clients with the gain loss report for your taxable accounts in the next week or so, as well as a checklist so that you can make sure that you've received all of your slips prior to filing. One thing to note in particular is that your T3 statement of trust income is expected to be mailed sometime at the end of March. Corporations have a deadline of March 30th, so unfortunately, as anxious as some might be to file their taxes, we do suggest that you wait till after you get your T3 slips, and you may not see those until early April. Okay, what's up for the next week? Well, as I mentioned, tomorrow we get the Bank of Canada interest rate decision, and we'll also see indications of inflation in China in February. On Thursday, as I mentioned, we get the European Central Bank's interest rate decision, and then on Friday we'll see the Canadian Labour Force Survey for February. Saturday we'll get another look at the Chinese economy with industrial production and retail sales. Monday we get the Bank of Japan's interest rate decision, and then on Tuesday we'll get a closer look at the U.S. consumer in February with the retail sales report. And of course, remember, the HighRock webinar will be next Tuesday. Well, that's it for today's discussion. Once again, we have gone well over our allotted time, so if you do have questions, please, we would like you to email them to us. We'd be more than happy for you to participate that way. We certainly want your feedback on our webinars. Tell us what you think is good, what you don't like, or if there's something else that we haven't been covering and you want to see us cover, please let us know. As always, thank you for taking the time to tune in. Have an excellent rest of the week and a great weekend, and don't forget to be back next week. Until then, this is Scott Tomlinson signing off.